Okay, good afternoon and welcome back everyone to our options education webinar series in 2022. My name is Tony Zhang. I'm the Chief Strategy Officer, and I am joined here by Jessica Inskip, our new Director of Education and Product here at OptionPlay, to discuss a topic that we have covered before, but not from the perspective that we're going to talk about from today, which is the wheel strategy. And if you're not familiar with the wheel strategy, it really consists of two core strategies that we've talked about before. Like I said, the cover call and a cash secured put. So what we're going to do is we're going to talk about the context of those two strategies and how you can utilize them in what we call the wheel strategy, which is really generating income round and round to buy the stocks that you want to purchase at a discount and generate an income stream on those stocks while you hold on to those stocks, looking for the capital appreciation that you're expecting in those underlying stocks and ETFs. So with that, I want to bring in Jessica Inskip, our new Director of Education and Product, to introduce this one strategy, and I will come back and talk a little bit about the mechanics of implementing this strategy within your portfolio. Jessica, welcome and joining us today.
Yeah, thank you, Tony. Happy to be here. I'm really excited to talk about this topic. There's been a lot of questions around it, and there's certainly been a lot of positive feedback as far as talking about this strategy and how it's been growing in popularity. So definitely make sure that you throw in your questions, and we'll be sure to answer them and help you along the way. So thank you for welcoming, Tony. All right, so let's get started. So before we get started, as usual, we do have to start with an important disclaimer. So types of securities, forms, and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by OptionPlay or solicitation or an offer to buy or sell any securities. This video is not intended to be used for individual tax, legal, or investment planning advice. All examples are for illustration purposes only and do not include any commissions or fees. So let's talk about what we're going to actually dive into. So we're going to start with an overview of what the wheel strategy is. I've got an illustration that I put together for you that'll just really describe on a high level exactly what you're looking for. Then we'll break down the components of the wheel strategy, which is the covered call and the covered put, and just a quick review and reminder of exactly how that's made up and the components of it. We'll of course have some examples that we're going to go throughout. Then I'll hand it over to Tony once we've covered the foundational elements of what the wheel strategy is and go over optimal calls and optimal puts and how to find them and utilize the platform. And of course, opportunity reports to find those ideas and trading tips when you're going to implement this strategy. But the real question that we want you to keep in mind that we're going to answer with this presentation is, how can I maximize yield and participate in capital appreciation utilizing options? So with that, we'll dive right in. So we'll start with the first illustration here, which is what is the wheel strategy and breaking that down. So it really is utilizing the obligations that are inherent of options to define entry and exit points to buy and sell securities. So when you're selling options, you collect premiums in exchange for an obligation. The put obligates you to purchase securities when it's below your strike, and the calls obligate you to sell the stock when it's above your strike. When you're selling naked calls and naked puts independently, so individually on their own, your goal is for the contract to expire worthless, and you don't want it to be assigned. That's certainly not the intent. When you're trading the wheel strategy, you actually welcome assignment. You're okay with buying and selling the underlying security. It's the underlying intent. So you really switch your thought process in regard to just the individual trading of short calls and short puts to really welcoming assignment, capitalizing on the obligation that's inherent with those securities. And you use those obligations to choose entry and exit points, very similar to limit orders. And in a comparison to actually purchasing the underlying, it allows you to reduce your risk and maximize your gain. And we're going to talk a lot more in detail about that. So in all reality, the wheel strategy allows you to create continuous income. So that's the purpose here, is you sell a put to collect premium. If it expires, so your obligation does not kick in, then you go ahead and you sell that security continuously. Once you are assigned and you buy the security, it allows you to purchase the stock at a discount because you're bringing in that premium that that obligation provides. And so therefore you can buy it at a lower price because of the premium and the obligation put together in your strike. And again, we're going to go over lots of details and examples throughout. And once you buy the stock, it still allows you to participate in capital appreciation because it's inherently a bullish strategy. When you are participating or utilizing the wheel strategy, you're utilizing it with stocks that you want to purchase. Therefore, you are bullish, and the purpose is to create that continuous income, purchase the stock at a discount, participate in the capital appreciation. Once you purchase the security, you sell a call to collect the premium to establish your upper limit. And then if it does expire, you just keep within that process. If it is assigned, you sell the security and begin again. So this is the first time I'm showing you this illustration. We're going to revisit it once we go through with some clarification as far as how this strategy is implemented. But I just wanted to show you this to get an idea of what the wheel strategy is, and we'll talk about this in further detail. All right. So let's start by reviewing the first part of the wheel strategy, which is a cash covered put. So if you've utilized options before, a long put holder, so the person purchasing the put, has the right to sell at the strike. You, as the short put holder, have the obligation to buy that security at the strike price at the long holder's discretion. So I've used this analogy all too often, but with options, when you are the short option holder, you are the passenger in the seat. The long call holder is the driver. So it's at their discretion. They can submit exercise instructions. They're the ones choosing if they're left, right, or stopping. They're driving the car. You as the short holder are the passenger, and you create that obligation. You can see your surroundings and get an idea of what the driver is going to do. But at the end of the day, it's the driver's decision, and you're obligated to follow along at their discretion. So your obligation inherent with the short put is purchasing the securities. So if you have the long put holder has the right to buy, or excuse me, right to sell at a specified price, your obligation is to buy. So in order to have a cash covered put, it's considered cash covered, meaning you utilizing the cash side of the account doesn't necessarily require margin. One or the other will work. But remember, with the wheel strategy, your intention is to buy the security. So you have to have the cash available to cover that obligation. So if you have a put that represents 100 shares of ABC at $100 per share, you're going to need that $100 per share set aside in order to buy. That is your collateral for the cash covered put. You sell a put option utilizing that cash as a collateral in exchange for a premium. And then that creates an obligation for you to buy that exchange traded fund or product or stock. And essentially that's a bullish strategy. The cash covered put on an individual basis is bullish if the underlying is above your strike price. The put's not worth anything. Therefore, that's when you keep your credit and you will do it again and again and again. So that this is bullish on its own. That's the part I want you to keep in mind. It's just these are the minimum requirements to have a cash covered put. On to reviewing a covered call. So once you're assigned on the put side, when you're writing a short call, you are selling the right to buy a certain amount of shares at a specified price within a specified time frame. So the long call holder wants the stock to move above the strike as much as possible. So that's on the long side. You, as the short option holder, individually, so without being covered or even being covered, as the short call holder, you want it to go just as high as the strike. So this line right here, and you actually cap the upwards basis. So individually, a short call is actually a bearish position. If you were to look at the profit and loss diagram of a short call, it's actually on the other end. And the way they work is as the stock price goes up, this is gain. And as the stock price goes down, this is loss. So if this was flipped, you would receive gain if the stock was to go down. With the addition of an underlying security or covering the call by owning shares, you create a bullish position with the covered call. So whereas individually a short naked call, so you're not covered by anything, is actually neutral to bearish, now we switch this from neutral to bullish. And that's the important component that I'd like you to take away from this. So this line represents you owning the underlying security. When you own the underlying security, you own that's the max risk, is how much you've spent on that security. When you add a covered call, you actually cap your upwards gains potential because you're creating an obligation saying, I'm willing to sell these securities at this strike price. So that's something that we're going to capitalize on when utilizing the wheel strategy. But in addition, it reduces your cost basis for the underlying security, which is what the difference of these two represent. And again, we're going to go through that in a little more detail. But in order to meet the minimum requirements to create a covered call, you have to own 100 shares of an optionable stock or ETF. You sell a call option using that stock or exchange traded fund as collateral. And in exchange, you receive a premium and subsequently reduce your cost basis. And you create an obligation to sell that stock in ETF at a specified price. So those are both bullish strategies. The covered put has the obligation to buy, and the covered call contains the obligation to sell. And we're going to utilize those obligations within the wheel strategy to define our entry and exit points. So let's look at this chart here, and I'm gonna go through this scenario through the eyes of someone who trades stocks individually on their own, or someone who trades stocks and options. And that'll help give you clarification as the different scenarios and risks and outcomes as far as if this strategy is good for you, but also from an educational perspective, it's a great way just to really understand the components that makes up the wheel strategy. So if I'm looking at this security, it's ABC Inc. And I've decided through my methodology that I'm bullish on this security. Remember, that's an important part of the wheel strategy. So you want to do this on a security you are willing to buy and bullish on. From a stock perspective, from my technical analysis, fundamental analysis, whatever methodology you utilize, I may say, I want to go ahead and do a buy limit order of this security at 50. I'm willing to buy this at 50. And I've determined an exit point at 58. So in order to do that, we'd have two limit orders essentially. We'd buy limit at 50, buy limit at 58. And let's assume it's 100 shares in this scenario. So in reality, I'm going to risk $5,000 to make a reward of $800. So that's the important component here, is risk versus reward. And now we're going to look at that through the eyes of someone who trades purely securities and someone who trades utilizing the wheel strategy. All right. So going through the example, what I'm going to utilize is a cash position of $5,000. So we've got our stock only trader, they've got $5,000, stock and options trader has $5,000. And we're both looking at this ABC security, buying the security at $50 per share. The stock trader is going to specify a buy limit order to buy 100 shares at 50 limit. When they specify that limit order, whichever broker you utilize, that $50 per share, that $5,000 becomes collateral for that order until it's executed. You can't utilize this $5,000 anywhere else. It becomes attached to that limit order. So that's what the stock only trader is doing. The stock and options trader is going to sell to open one ABC. And let's assume May 6th is about 30 days from now, a $50 strike at $3.15. So they're going to receive $315 per share and also have collateral of $5,000 with that obligation. Let me show you exactly what that looks like. So the limit order is going to execute immediately, because once we're purchasing, as soon as it hits the ask, it's going to go through as long as there's enough shares at that price. So the stockholder was debited $5,000 less commissions and fees and now owns 100 shares of ABC worth $5,000 total, or $50 per share. The stock and options trader now owns an obligation to buy 100 shares of ABC at 50. That obligation is only going to kick in if that put isn't worth anything. So, and we'll go through the risk in one brief moment. So in exchange for that obligation, they received a total of $315. That $5,000 that they started with becomes collateral. That $315 is set aside, but they've reduced their break even of the underlying security to $46.85, whereas the stock trader has $50. Because they received that premium, that's how they're participating and purchasing the underlying security at a discount. Now, there is an important part to note here, is that in the premium received, I do want to make sure that we adequately talk about risk and reward. So when you have a cash covered put, you are looking for that obligation to buy. That obligation to buy only kicks in if the underlying security goes below the strike price and extrinsic value is depleted, which normally happens on expiration or if it's super deep in the money. So since it contains the right to sell and you are worried about your likelihood of assignment, the best way to look at that is through the eyes of the long put holder. So this put contains the right to sell at 50. I always look at it through the person who's driving the car. If ABC is at 45, well, selling at the market of 45 is less advantageous than the strike price. So that's when the obligation kicks in to buy. So that's why strike price and expiration selection is extremely important. Where the risk comes in from the person who's trading the stock only or trading the stock in options only is if ABC were to skyrocket. And so that's also something to think about. If ABC were to go up more than $3.15, the stock only trader will make out better because the stock and options holder is, if the underlying security goes above the strike, then it's not going to be worth anything. Selling at the market is going to be more advantageous. So therefore, that's the strike selection and the premium received that you want to consider. But I do want to make sure that we adequately cover the risks involved with that, which are upward movement. Otherwise, we're reducing our downward risk, because when you're owning the stock itself, the most you can lose when you're purchasing the security is what you've spent on the security. So we're actually reducing our risk, but also upward potential. And that's something very important to cover in this scenario. If that does make sense, I would love for you to type 1 in the chat for me, because that's extremely important to go through. See lots of ones. Perfect. Great, so lots of ones. I appreciate that check-in. So now what I'm going to do is just go through the scenario, what happens at expiration, and we'll talk about these risks throughout as well. So let's go all the way to day 30 and see what happens. So ABC was up $1, so 2%. And I will, when I'm showing the change in ABC from percentage and price change, I'm looking at it from day 1 as we go all the way across, not day to day. So that's extremely important to note here. As ABC has gone above the strike, that obligation was not kicked in. Therefore, the contract expired. So in this scenario, the stock only trader did make 2%, because the stock went up $1, went up 2%, dollar for dollar. The stock only trader is going to make and capitalize on. The stock and options trader made, instead of 100, made 215 more. And so therefore they made 6% in this scenario. So you can see how it varies from capitalizing on that premium that was received. So now if you recall that image that we were looking at initially, the put expired. So in this case, the next step is to sell another put. If you are still bullish on the security, that is an important component of it. So now the stock and options trader is selling to open one ABC 51 strike another 30 days out at $3. So this time we raised our strike to 51 instead of 50. So our obligation is going to kick in at 51. So this particular stock and options trader is deciding to sell those at the money options. received $300 in exchange for that obligation to buy 100 shares at 51 per share. And that $5,100 of the cash that they have is sitting as collateral. So that's going to sit there if waiting for assignment. And you can see how, or briefly see here anyways, that when you continuously sell puts to collect premium, it simultaneously reduces the break-even point of the underlying. We reduced this another $2 in this case because we received $300 of premium, but we were raised our entry point by $1. So now our break-even is $44.85, where we can experience ABC going down and still be profitable. Whereas the stock trader, if the ABC was to go below 50, they would start losing money, whereas the stock and options trader would start losing if ABC were to drop below 44.85. So this is how we purchase the stock at a discount, but also reduce that risk. So going forward, another 30 days to expiration. Now ABC is flat and it's at 0, but the put contained the right to sell at 51. Selling at 51 is more advantageous than selling at 50. Therefore, our obligation to buy has kicked in. We are obligated to buy the shares from the long put holder through the exercise and assignment process, buying 100 shares at 51. So we're debited $5,100. We still keep our credit, but we are assigned. The stockholder is flat now, only made 0% because again, we're looking from day one and our $5,000 investment from both eyes. We're debited $5,100, but we made $515. So the stock only trader in this scenario is flat, didn't lose any money, didn't make any money. However, the stock and options trader is up $515 and made 10% in this scenario because they've kept the credit of $315 and $3, but we bought at 51 instead of 50. All right. So now that that's happened, we own the security. So the next step within that strategy is participating in capital appreciation now that we own the underlying security and selling a call. So in this case, if we want to sell the security, remember the stockholder had a target price of 58. So the price is at 50. They're going to go ahead and put in a sell limit order at $58 per share. At the $58 per share, that is going to take their security or their 100 shares of ABC and utilize it as collateral. If you are putting in a sell limit order at your broker, you're not allowed to do anything else with those shares because they are attached to that order. The stock and options trader is going to essentially do the same thing, as in utilizing their ABC stock as collateral, but specifying a sell price of 55. So they've decided, okay, I'm willing to sell my 100 shares of ABC at 55, and in exchange for that obligation to sell, I'm going to receive $2 per share. So they're accredited $200, and then our cost basis or our break even for that option, our underlying, is $42.85 in this case. And mind you, I am saying cost basis because that's from an educational perspective. From a tax purpose, it acts completely differently. There's a whole publication out on the irs.gov website that you can go through as far as taxes are concerned. But nonetheless, from a educational perspective or that cost basis view, we keep reducing our cost basis, which allows us to participate in capital appreciation, mitigate our losses in comparison to owning the underlying security individually. So now we've received a credit of $200. We have an obligation to sell at 55, same collateral. Let's move on and see what happens. So going to expiration, this expired. ABC is at $52 per share, so up $2, 4% from its original 50. Since that expired, we retain our credit, and remember it's a call, so the right to buy at 55 is less advantageous than what the market's pricing at 52. Therefore, this is worthless. We just keep writing income and writing calls to create that continuous income as we're on this side of the wheel now. So the stockholder did make dollar for dollar, so 4%. It made $200. The stock and options trader made 16% in this scenario. So moving forward to day 92 in this case, so the following Friday, the ABC is still at 2. What we're going to do is now sell another call. So this time, same strike price, sell 55, another 30 days out, and receiving a $2 premium in exchange for that obligation to sell. So we're still utilizing that collateral to sell at 55. The stock only trader is still utilizing their collateral to sell at 58, and we're receiving premium in addition to. So now moving all the way to expiration, day 117 within this scenario. And let's just say ABC all of a sudden skyrocketed and is up 20% from that $50 price to $60 per share. Well, the stock trader is going to be credited $5,800. That the bid is going to hit their price. Therefore, their order is going to execute and they're going to sell their shares right when that bid hits 58. The stock and options trader is going to have their obligation kick in and they are required to sell at 55. So therefore, they're going to be assigned and sell their shares and receive a credit of $5,500. And you can really see here how that continuous writing of premiums have reduced that cost basis or that break even on the underlying security versus owning the stock outright. And that's really the goal here for you to retain. So within this scenario, the stockholder turned their $5,000 into $5,800, making $800 and 16%, which is still a great gain. Any gain is great. But the stock and options trader utilizing the wheel strategy was able to turn their $5,000 to $6,415, making 28%. So there's the difference there. And mind you, that there was a limit order for 58 versus the 60, otherwise it'd be dollar for dollar. So I hope that added some clarification as the use of the wheel strategy and how you can utilize those obligations that are inherent with cash covered puts and covered calls to buy and sell stocks, much like limit orders. So I'm going to bring up that view one more time. So with the wheel strategy, you can see here just selling the premiums, you're collecting them constantly. Once you're assigned and you buy the security, you are still purchasing the stock at a discount and participating in that capital appreciation. Then you utilize the calls to specify your exit points. So you sell at the strike. And then once assigned, if you're still bullish on the security, you can continue on that cycle. So with that, I'm going to hand it over to Tony and we'll talk about optimal covered calls.
Yeah, thank you so much, Jessica. That was a fantastic breakdown of the strategy from a theoretical perspective using stock ABC. When we use that just to illustrate the examples to make it easier to understand, especially if this is your first time using some of these strategies, before I jump into this, I just want to do a quick poll to get a sense for the audience here in the room. What's your experience with options trading? Are you just learning how to trade options? Do you currently trade options? Do you have a fair amount of experience? I'm curious as to the audience here in today's room. And it looks like, the majority of you have some options trading experience and the other half is split between just learning and your experience. So what I want to do now is really take this from a more academic perspective into the real world, looking at some real world examples and applying what you've just learned, the purchase of a stock using a cash secured put at a discount and selecting expiration dates and strike prices, and then looking at the same thing, looking at expiration date and strike prices on selling that asset through a covered call and generating income while you wait to hopefully sell that asset at a profit in the future. Okay, so 60% of you, almost 60% of you have some options trading experience, 22% of you are brand new, 18% of you say you are experienced. So regardless of what your experience level is, what I want to do is I want to show you how to apply what you've learned from Jessica's session in the real world. So let's first start off with the covered call. And I want to use a real example of a stock that many of you may hold in your portfolio, Barrick Gold. A lot of you in Canada have mining stocks, energy stocks, and banking stocks in your portfolio. So Barrick Gold, certainly one of the largest mining stocks, especially in the current environment. Very likely that you might own this stock in your portfolio. So let's see this particular stock and looking at specific expiration date and strike prices to help you understand how you can select the appropriate strike prices for your cover calls. Barrick Gold currently trading at $32 and change here. And what I have here is we have back tested selling these cover calls on a variety of expiration dates and strike prices. And I want to do a thought experiment to see what would you choose if you had the choice? And this is a limited choice, right? Because when you look at the options chain, there's a lot of choices. You have a lot of expiration dates and strike prices to choose from. So I've already narrowed it down to a few choices, and I want to get a sense for which one would you choose. So like I said, the stock is currently trading at around 33 and change. And what I have is the 33s, which if I draw on the chart is around here, the 34s, which are right here, and the 35s. And this represents how far the stock needs to rally over the next period of time between now and expiration before your stock is called away. And if you see here, the 35s collects 40 cents in income, the 34s collect 60 cents in income, and the 33s collect 85 cents in income. And these are your raw and annualized returns. Your raw return tells you how much income you collect between now and expiration. And the annualized number just tells you what that number looks like if you were able to collect that type of premium throughout the entire year so that you can compare, different time frames, apples to apples. So in this particular case, you have these three choices. Now, if you don't mind, please bring up your chat window and type in the specific strike price, the 33, the 34, 35 that you would choose if you were looking at selling a cover call on Barrick Gold for your own portfolio. Please type your answers as to which strike price you would choose. I see a lot of 34s and I see a lot of 35s. This is actually quite unusual. Usually when I do this type of thought experiment or when I ask this type of question, the answers tend to gravitate towards the extremes, either the 35s or the 33s. But what I'm actually seeing right now is a lot of 34s and a lot of 35s. That seems to be the predominant answer. So this is really where I can really fast track based on our research, and this is done from 2007 to today, looking at just about every single stock in the optionable universe to test cover call strategies and seeing which strike price gives us the best outcome in the long run. And it's overwhelming, and the evidence is really overwhelming. There's no gray area. It's very black and white in terms of that the best performing strategy is actually these higher strike cover calls, and meaning the ones with actually the lowest returns. And this is really shocking for a lot of investors, that how is it that the lowest return strategies generate the best outperformance in the long run? And it really comes down to the fact that this collects a relatively small amount of income, especially if you compare these two numbers, right? 40 cents versus 85 cents. But you really have to think about what you are giving up for that extra, in this particular case, 45 cents. One, you're generating 40 cents in income. One, you're more than doubling that at 85 cents. But what are you actually giving up by doubling your income? Because what you're really giving up here is the capital appreciation in the underlying stock itself. So what you're giving up is $2 in capital appreciation, because if the stock rallies from here to 36, in one instance, you've sold your stock at $33. In another instance, you sold your stock at $35. Now, I think in hindsight, many of you will say that if the stock rallies to 36, you'd much rather sell at 35 than at 33. I think most of you agree that if you sold your stock at 33, that would have been too early. So what you realize is that for an extra 40 cents in income, what you give up is $2 in capital appreciation. And that is a formula that will never give you a positive outcome in the long run. If you keep giving up $2 in capital appreciation for just 40 cents up front, you're going to come out behind in the long run if you keep prioritizing higher income. But if you prioritize lower income, but prioritize capital appreciation, that's how you come out ahead in the long run. And that's what the overwhelming evidence of our backtesting shows us, is that when you select strike prices that are relatively far away from the current price, using delta-based approach, a delta is simply looking at the probability of the stock above that strike price at expiration. So a 20 delta translates to a 20% chance that this stock will be above 35 in that expiration cycle. That means 4 out of 5 cover calls you sell on Barrick Gold, you are going to collect 40 cents each in 4 out of the 5 instances. And in the 5th instance, that is likely, or in 1 out of 5 chance, you will have the stock rally a fairly significant amount, and you'll actually take profit on that stock in itself. So that's really why the 35 strike, the strike that's furthest away from the current stock price, is the one that generates the best results for cover calls in the long run. Does that make sense to everyone? Please type 2 into the chat window if that makes sense to you. Perfect. Okay, I see a lot of 2s. Okay, so now take that, if there's nothing else you learned from this today's session, I think this is one of the more important elements to helping you understand the strategy, or more practical approach as to how you can implement what you've learned here today. Okay, now the second most important thing I think to really learn today is really which strike prices do you choose to sell in cash secured puts. So here I'm going to use Air Canada as an example, because perhaps this might be a stock that you've been thinking about buying. You know that things, the airlines are reopening. You know people are traveling more, but oil prices have kept airline stocks kind of to the downside. And maybe you think now, as oil is stabilizing a little, now is the time to consider buying some airline stocks, especially as you've seen some of the US airlines perform well. So Air Canada is currently trading just above $23. And I have a few different choices here. I have 22.5 as a strike price. I have 21.5. And then I have 20.5. So that represents how far Air Canada needs to decline by before you own the stock to potentially take advantage of the capital appreciation of the underlying stock. So similar to placing a limit order at a lower price, how far would you place your limit order away from the current stock? So in this particular case, I have 3 choices. The 22.5 strike collects 80 cents, the 21.5 strike collects 50 cents, and the 20.5 collects 35 cents. And these are the corresponding raw and annualized return, meaning how much am I collecting in the next 30 days or so? And if you annualize that out, what are the returns? So same thought experiment. If the stock's currently trading at 23, which one of these 3 would you choose? Type your strike price into the chat window. Which one would you choose? I see a bunch of 22.5s. I see a bunch of 20.5s. So this one is a little bit more, what I had expected. The answers tend to gravitate towards the 22.5 and the 20.5 number. I see a few 21.5. So this one's pretty balanced here, if you will, between the answers. And this is also something that we've backtested substantially in terms of where do you get the best outcomes in the long run. And this is really where, from our research, the 22.5, the strike price that's closest to the current price, is the one that gives you the best outcome in the long run. And this is because, for 2 primary reasons. You're selling a cash secured put for the very reason because you want to own the stock. So when you choose a strike price close to the current price of the stock, you have the best probability of owning that stock and actually participating in that capital appreciation. Because if you sold the 20.5s and the stock pulled back modestly and then continued to rally, guess what? You didn't participate on that rally. You just collected the premium. That's it. So that's why when you're selling a cash secured put, you want to prioritize strike prices close to the current price so that you have a high probability of actually owning that stock. And then the secondary benefit of using strike prices close to the current price is that you get a relatively large static return. So that worst case scenario, let's say the stock just simply takes off and never even looks back. Well, guess what? You have a fair amount of yield to show for the cash that you put aside for 30 days, hoping to own Air Canada. Just because you didn't participate on it because the timing just didn't work, or you just the stock just took off and you never looked back. Well, in that particular case, you didn't have a bad result. You got a 39% yield on the cash that you set aside for those 30 days. That's not a bad result in the long run. So that's why when you're selling cash secured puts, you want to select strike prices close to the current price. Does that make sense? Please type 4 into the chat window if that makes sense to you. So remember, selling cover calls, you want to sell strike prices far away from the current price. Selling cash secured puts, you want to prioritize selling strike prices close to the current price. Okay, so now that you've learned this, there's still the aspect of taking what you've learned here today and pulling up an options chain and searching for this stuff and figuring it out on your own. Well, this is really where we've taken that even one step further. We want to help you do the work for you. We have a cover call opportunity report that we publish here at OptionPlay, and you can access it completely free of charge as an OptionPlay Canada member. And I'll show you how to access it. And you can take a screenshot here with your phone if you want, or just take a screenshot on your computer with that QR code that will take you directly to this report. And you can also access this report at trade.optionsplay.com/TMX income. The QR code, the link, they all take you to this income-based report. And I'll even post this link into the chat window. So if you want to have this link bookmarked in your browser window, you can do so. But what we have is all TSS listed stocks and very liquid ETFs updated once a day, sorted by the highest raw return or the annualized return in terms of both cover calls and cash secured puts. So you can see which stocks do you generate the most income on these types of reports. And basically what I suggest for most users is to use this report by simply going down the list of stocks that you own. So you simply go down the list and find stocks that you own, and it will tell you which expiration date and strike price that you can sell and how much yield you can generate. And you can even click on this link here at the very last column, the trade link button column, and it will actually open the trade in OptionPlay and evaluate the trade on your behalf. So this is something that you can access here directly using this link here on your screen, or using the QR code here that you see on your screen that will take you directly to this trading report. Whoops, I must have broken link here. I apologize. I will fix that after this report, but that link will stay the same. Give me 1 second to pull up this report. I apologize for that the link is broken, but I will again make sure that that is fixed before the end of this webinar. Okay, this is the report. I will, again, like I said, fix the links before before we end today's session. But as you can see, you can simply go down this list, and it's sorted based on highest yielding returns. And you can simply go down the list and find the first stock that you own. So let's say in this particular case, I'm just looking for some stocks that are probably widely held, maybe something like Shopify, or let's say CCO. These are some of the heavily owned stocks. X, CG. So you basically go down the list, or Royal Bank of Canada, and you simply look at which expiration date and strike price you could sell for this particular stock. Let's say on Royal Bank of Canada, and it will generate 1.82% static return and 22.87% annualized return. And if you look at this particular report, let me just make this a little zoom in so that you can see it, you can click on this link here on the right-hand side, and it will actually open this trade within OptionsPlay so that you can analyze this trade even further if you want to make any adjustments. So for example, if you want to modify this to change this to a different strike price, maybe you want to change it to the 170s or the 160s, you can be a little bit more tactical, and you can see the changes in this particular strategy relatively quickly by just using the OptionsPlay tool. So this is something that you can use OptionsPlay for, along with this report, to find opportunities to generate income on your portfolio. And you have both a cover call report and you have a short put report here. Both of them are within the same link, and you can use the same process to look for stocks that you want to purchase, but do so potentially at a discount. So let's say you're looking to purchase, Shopify is probably not a great example because it requires a fair amount of capital to do so. Let's look at a stock that maybe many of you might be interested in purchasing. And I'm looking at some stocks that perhaps many of you are interested in owning, right? Let's take a look at EQX. And what you can do, again, you can click on the link here on the right-hand side. It will populate the trade within OptionsPlay that will allow you to analyze this particular trade and understand the yield of these, as you can see, this is a 4% static yield, 55% annualized return. Compare that to a stock that pays zero dividends. This is one that you might want to consider if you're thinking about selling a cash secured put on this particular stock. So this is just how you can utilize both the cover call and cash secured report to implement what I've shown you. I've walked you through the thought experiment as to why, when you're selling cover calls, you want to choose strike prices that are relatively far away from the current price. And then when you're selling cash secured puts, selecting strike prices close to the current price of the stock. Well, this report implements that for you, picks the expiration date and the strike price based on these best practices already built for you. So this is a report that from my perspective, every time you're looking to sell a cover call or a cash secured put, you should be logging onto this report and getting a good sense for where you should start your research. It doesn't mean that you'll end up selling that very specific expiration date and strike price, but it at least gives you a really good starting point so that you're aligned with the best practices with what we've just taught you here today. So just a few tips before we open this up for Q&A here. Remember that when you're thinking about these types of strategies, you should always focus on stocks that you're familiar with. So when you look at this long list of stocks, if you're not familiar with the stock, you shouldn't even bother looking at it, because you need to own, with both of these strategies, you either need to be comfortable owning the stock or comfortable holding that stock. And generally speaking, you don't want to invest or hold stocks that you're not familiar with. So do your research on the underlying, make sure it's a stock that you understand from a fundamental perspective, make sure it's a stock that you feel comfortable owning as an investment. Those are the stocks that you need to focus on within this list. And if you're looking for a higher yielding income portfolio, simply look for the ones with the highest returns on this list. This list is already sorted for you based on return. So basically look down the list for stocks that you're familiar with and stocks that you want to own. And that's how you prioritize creating a high yielding portfolio using this specific wheel strategy. If you have a small account, I get a lot of questions saying, I don't have enough capital to buy 100 shares. Well, that's okay. You can actually sort this based on the stock price itself. So you can just sort based on the lowest price stocks. So, CG only requires $1,300 to buy 100 shares. You may not have enough capital to buy 100 shares of Shopify, but you may have enough capital to buy 100 shares of CG or any of the lower price stocks. So that's another way that you can use this particular report to give you a better sense for how to build a portfolio using this type of strategy. And lastly, make sure that you look at the earnings flag. It's important to understand whether there's an earnings between now and expiration, and that is something that you can use to give you a better sense for this particular type of strategy. So when you're using the OptionsPlay tool, it'll give you the earnings date so that you know whether or not there's earnings coming up. And when you hit the trade button, we also have a strategy checklist that checks for your earnings date. So within the OptionPlay platform, whenever you hit the trade button, there is a strategy checklist. The strategy checklist has the earnings date. It gives you an idea as far as whether a stock is about to report earnings. Generally speaking, with these types of strategies, you want to avoid stocks that are reporting earnings in the next week or so. If they're reporting in 3 or 4 weeks, then I think it's still worth potentially looking at this particular trade because you have plenty of time between now and that catalyst event before you have to make a decision. So those are some of the tips that I have for utilizing the wheel strategy in your overall portfolio. So with that, that covers what I wanted to share with you here today. You know, the secondary element of what Jessica spent the first half teaching you, which is the concept of the trade, but then how do you implement this trade using the tools that are available to you. And all of this is completely free of charge at tmx.optionsplay.com, which I will post the link here into the chat window here as well. I will update the trade link that I have with the reports, but you can access everything through tmx.optionsplay.com. If you don't already have a free OptionsPlay Canada account, I highly recommend that you sign up and register for one at tmx.optionsplay.com. It'll give you access to these daily income opportunity reports that I just showed you for cover calls and cash secured puts so that you can implement the wheel strategy. It includes monthly options education sessions like the one that you are registered for here today. If you're registered for the one today, you're automatically registered for all of the sessions that Jess and I will be doing for the rest of the year. So this, all you have to do is register once for these events and then access to the OptionsPlay Canada tool. This is the tool that I'm referring to. There's a lot more in this particular tool that we'll be showing you over the next few months. Jess and I, when we do these events, every time we do one of these events, we'll show you how to utilize the tool a little bit better for different types of strategies. But for today, what you're focused on here is income generating strategies, cover calls, cash secured puts. And when you combine them into together, we call it the wheel strategy because you're basically generating income round and round. That's why we call it the wheel strategy. And hopefully today we were able to show you not only the wheel strategy in concept, but more importantly, how to implement it for your own portfolio and searching for ideas using these income opportunity reports. So with that, what I'm going to do is I'm going to open this up for Q&A. There is both a Q&A section and a chat window section. If you don't mind, please type your questions into the Q&A section, and Jess and I will answer as many questions as we have time for before we have to sign off. And in the meantime, while Jess answers a couple of questions here, I am going to update the trade link so that we can all see these. We can see the reports, everyone, with the links that was unfortunately broken before. So give me one moment and I will be right back.
Okay, while you're doing that, I do see one that just asking to explain raw return again. So that's just the premium that you receive from the cash covered put or the covered call relative to the stock price, so you can compare it to the dividend yield. So premium divided by stock price times 100 is the formula.
Yeah, that's exactly right. It's just the static return of the premium versus the stock price. Mm-hmm.
See a couple questions on what level of options trading account does it need. Now that honestly varies from broker to broker. You're looking for the ability to have cash covered puts in covered calls. And so I've seen that be 2 and 3, depending on your broker.
And sorry, everyone, the link has been updated and I just posted the link again into the chat window. You should be able to click on that link now and access these income reports, both the cover call and cash secured put. It's telling me that the page is still broken. 1 second. I apologize.
I'll answer the questions while you're doing that, Tony. No problem. I see one from Kaz. When is the next webinar, and are these recorded? Yes, they're recorded. They will be posted and sent out via email after the session, and we're actually going to do one once a month. So if you have any suggestions on future topics, we'd also love to hear that as well.
And those links should now be updated. Once again, I will test before I say that one more time. Yep, okay, they are now working. So apologies again, the link has now been updated. It is now a link that you can click on in the chat window. You can now see those reports using that link. Okay, now let me get back to some questions. Popeye is asking, how do I get the right panel view that you show? If you don't see the right panel on your screen, let me just share my screen for a second. If you don't see this panel here on the right, chances are you have this button that says show trade panel. If you click on that button, that will expand out to show you that third column. Does the percentage return and cover calls include dividends? No, David. So that's why we have on our platform what we call, let me go back to the income tab here. That's why we have this 12-month projected yield. The 12-month projected yield is basically taking the annualized return from the cover call or cash secured put and adding to that the dividend yield. So that's what the 12-month projected yield is. That includes the dividend yield, but the annualized and raw return does not include the dividend yield. Sebastian's asking a question, a good question, which is, should you wait for a stock to be up or down on a specific date to wait to sell a cash secured put? And this is really where the statistics don't really show a strong advantage to one or the other. Waiting for a down day versus an up day doesn't statistically change the strategy, the strategy's results over the long run, at least not over a single day. We tend to find that if you measure momentum over a longer period, let's say over a 7 to 14 day period, and wait for more of a, what's the correct word? An adverse move in the direction that you expected to. So if you think the stock's going to go higher, waiting for momentum to be negative, if you will, does increase your chances of success, and vice versa. If you're looking for a bearish move, waiting for momentum to have a big positive move, we kind of basically mean reverting, which is what momentum trading really sometimes comes down to. That is where we do see some statistical advantage, but over a single day, the statistics is not really there. Karun is saying, could you please discuss strategies for sold cash secured put when stocks go below your break-even price? That really has nothing to do with the cash secured put. That really just has to do with your long-term stock investment strategy. The rule of thumb here is really just, you have two choices on a stock that's below your cost basis. Either you still believe in the company and you think that that's still the best use of your capital is the future appreciation of that one specific company, or you've identified better opportunities in the market. And in that particular case, you're better off selling your stock at a loss and redeploying those assets somewhere else. It's just a matter of whether or not you believe that the current holdings that you have in that stock that you're losing money on is the best opportunity for your capital in the market. That's a different decision that everyone makes, and how you go about making that decision is obviously going to be quite different from one person to the next. Some people rely on technical analysis, others rely on fundamentals. You might look at analyst price targets to determine that, where do you have the best opportunities? That's a different decision that every single person makes, but it really should be rooted on where do I have the best opportunity in the market? Not based on the fact that I'm taking a loss and I don't want to take a loss, so I'm going to continue to hold on to this stock because it could be dead capital and you're better and you perhaps may be better deployed somewhere else. It really has nothing, in my opinion, to do with whether you sold the cash secured put or not.
Scott has one on owning a stock and not wanting it to get called away, utilizing the covered call. So you had a good suggestion in there with the 10% delta or the 10 delta. That is certainly going to be a lower probability of you being called away. But essentially, if you do sell a covered call, you still have that risk. And the only way to take that off the table is ensuring that you don't have the obligation, so closing it. So no, that is a risk. If you do sell a covered call, you could possibly have it called away, but those lower deltas will reduce that risk.
Right. And Steve's asking, how important is volume when picking a stock for the wheel strategy? So Steve, the TMX has already done a lot of work for you on this front, because in order for a stock to even have options listed on it for you to trade the wheel strategy, it already meets some pretty stringent volume and kind of liquidity metrics. So you as a retail trader will never ever come close to tapping out the liquidity of an underlying stock. That's usually a problem for institutions, pension funds that are trying to acquire a sizable position in a specific stake in a specific company. Like when Elon Musk buys 10% of Twitter, that takes a lot of capital to go about doing so, and you have to worry about volume and liquidity. But, the 300 so names that are listed with options on the Canadian markets, those names all have sufficient liquidity for any retail trader. So any stock that has options listed on it, from my perspective, has sufficient liquidity for you to trade the wheel strategy. Stephanie is saying, as step one, should we filter for stocks where IV is higher than historical volatility for short trades? So when you refer to short trades, I'm presuming that you mean short options trades, so short calls, short puts. Now, in a pure statistical perspective, you are correct. Stocks where IV is above historical volatility will give you a statistical edge on selling options. But that, that's only one step, right? Because you then still have a directional view to add on top of that. So yes, that could be step one, but there are plenty of other steps in addition to that. Does the tool show you the best cover call or put in a given week? So Greg, that's what the cover call and short put report does, is it shows you where we would start our research, or at least based on our best practices that we have back tested, where we would start our research. And it gives you that starting point. It doesn't mean that that's exactly where you'll end up, but it gives you a really good starting point. In many option strategies, we usually want to avoid the expiry date of the option. Is there an advantage in buying to close before the call or put expires? So in a cover call, the advantage to buying to close before the expiry is to prevent your stock being called away. So for some investors, you want to own that stock. You don't want it to be called away. So you do want to buy to close before expiration. But the short put, your primary goal is to own the stock. So in that particular strategy, you generally don't want to buy to close unless something has changed fundamentally about your decision to own that stock from the time you sold that put to the time of expiration. So let's say I sell a put, and after I sold the put, some news comes out, or some earnings event comes out, or something that fundamentally changes my view as to whether or not I want to invest in that stock. Only in that instance will I consider buying back that put, because now, for example, maybe I no longer want to purchase that stock. So I'm going to buy back my put and remove my obligation for owning that stock. Can we use credit spreads in the strategy? You can. So credit spreads simply remove the need to either, but the one thing I will say is that credit spreads will significantly reduce the income that you collect on this type of strategy. It will also significantly reduce the risk and significantly reduce the amount of capital required to enter these strategies, but it also significantly reduces the income, usually in the order of about, removing close to 70, sometimes even 80% of the income from the strategy by using a credit spread rather than the outright call or put. When should you close out a cover call if you don't want your shares called away? Generally speaking, I would say in the last week to 2 weeks is kind of that time frame where you would close out a cover call. In the right panel, if you see the 3 strategies, then click on the income tab on the upper right-hand corner. So if you see the 3 strategies, then you're on the trading tab. As you can see, there's an income and a trading tab. Click on the income tab to see the tab that we are referring to here today. Jess, I don't know if you have any thoughts here, but are there any technical indicators that you use to complement your options trade?
I have a lot of thoughts on that one. I use a lot of technical indicators. But primarily for options, I do like to utilize indicators that specify support and resistance. That way I can choose optimal strikes based on that. Otherwise, I like to complement them with momentum and Fibonacci and things like that to indicate if I'm bullish or bearish or they're trading in a channel. But primarily support and resistance, I think, are extremely important.
Yeah, I think, predominantly momentum is going to be the main indicator that I use for these types of strategies. And from my perspective, I get a lot of questions regarding which momentum indicator I use. I always tell users it doesn't really matter. They're all measuring the exact same thing, just slightly different mathematical calculations to go about doing so. So using 3 momentum indicators is not going to give you any advantage to using just a single one. Pick one that you're familiar with, pick one that you understand, pick one that you are comfortable using, and stick to it. That will pay more dividends than using multiple momentum indicators. And one last question here, Howard saying, could you define what criteria goes into the score rating shown in your trade ideas window? Great question. So the score gives you a sense for relative strength. The relative strength tells you which are the strongest stocks in the market, like PEY. If you look at this particular stock compared relative to the market, this is a stock that's outperforming the broader markets, especially if you look at, let's say, XIU, the S&P TSX 60 index, or the TSX composite index. And then the scores of ones are the stocks that are underperforming the market. So as you can see, while the markets are trading sideways or trading slightly lower, Canada Goose is significantly underperforming the market. So the scores tells you relative to the market, is this a stock that's outperforming? Those are the 10s, or is it underperforming? Those are the 1s. So if you're looking for bearish opportunities, the 1s tend, the lower the score tends to increase your probability of success on a bearish trade, and the higher scores tend to increase your probability of success on a bullish trade. And with that, I believe we have answered all of your questions here for today. So thank you so much, everyone, for your time here today. I hope that this was helpful in giving you a better understanding as to the wheel strategy. Thank you so much to Jess to breaking down this strategy on a more fundamental basis so that you can understand it from a conceptual perspective. I hope that I was able to add some color to this by showing you how to practically apply this to your portfolio and showing you the tools that are available to you completely free of charge. Thankful to the TMX exchange that give you access to the cover call reports, the OptionPlay tools that help you implement this strategy. So I hope that you sign up using tmx.optionsplay.com or using the trade income report, which again is trade.optionsplay.com/TMX income, which I posted into the chat window here one more time. And we will send you both the recording and the slides so that you'll have this QR code, you'll have these links in the slides and the recording so that you can view them again at your own speed. With that, thank you so much. Have a great afternoon. And I'll see you guys next month back here with Jess on our next options education session. But if you're registered for today, you'll automatically receive the reminder for that next education event. With that, thank you so much and have a great afternoon.
Thanks, everyone.